Hello and welcome everyone to the presentation that we have done jointly with FinTrail titled What FinTechs Need to Know About Geopolitics. This section I'll be discussing our contribution as FinGY Group to the white paper, and also in this roundtable segment I'll be diving into some of our sections and why FinTechs really need to have a much better understanding of geopolitics if they're going to be successful in the next 10 to 20 years as a FinTech for their business development and also for their compliance function. So without further ado, let's get started. As I mentioned before, this is our white paper, as you see on your screen, a beginner's guide to geopolitical risk and how it's impacting fintechs. If you take out your mobile phone and pause this video, you'll be able to open up your camera app and just point the camera to the QR code, and at the top of the screen, you should get a pop-up, which then when you click that will take you to the white paper, so you have a chance to read it. So pause it right now and you'll be able to do that. Okay, so there were three things that we came up as a conclusion between FinTrail and ourselves at FinGY Group that are worth mentioning off the bat at the very beginning. Firstly, our main conclusion is that fintech professionals, especially in the risk management side of business, lack a robust and up-to-date understanding of geopolitics and what we call globalized power, and how it impacts risks. Typically, the most prominent type of risk analysis is what is mandated by the regulators. So in the UK's part of the world, it would be the FCA. In America, it would be the SEC and others as well. And in other parts of the world, it would be their respective regulatory bodies. But this is not enough. If you're going to be successful in developing your fintech, and also staying compliant, but also understanding what risks and opportunities there are beyond just the bare basics, and having a much more deeper understanding of geopolitical risk is very, very necessary. And this is something that fintechs across the board need to do a lot better. Secondly, especially for those in the leadership positions like the chief investment officers, the MLROs, or the chief risk officers, or those in management, and also all the way down to the analysts, need to develop a much more hands-on approach to understanding geopolitical risk, especially when assessing undiscovered and future risks to the business. Right now, the majority of firms that we have spoken to typically have a very light touch approach to geopolitical risk, where they may read some news headlines in newspapers and are subscribed to some free newsletters to keep them up to date on current affairs. But current affairs are a deeper insight into how power is developing and what the fundamentals of national power are. Is very, very fundamental to any fintech who is looking to develop and who is looking to have long-term success in their business. So this is our second point. Thirdly, given the changing nature of world affairs, fintechs are experiencing a growing need to hire for geopolitical risk skills. And this is difficult, especially when one may not know what kinds of things to watch out for in a potential candidate when understanding geopolitical risk, because regurgitating current events is one thing, as I mentioned, but really having a grasp on their ideas of how the world is moving forward and how this will impact their business is something that needs to be trained, in our opinion, into the hiring team and also into the leadership teams. So in creating training or purchasing training from outside vendors, they know exactly what to hire for and what to look for in candidates, because they have themselves, as the hiring team or the management team, they have a much better understanding of geopolitical risk. Now, the rest of this talk, especially in our section, will dive into what geopolitical risk is, how we have developed our own very unique way of understanding it and measuring it, and also a few case studies at the end which apply geopolitical risk to the real world in the fintech world in a non-obvious way. And as I mentioned before, this is the last point was the main point that we try to get through with this white paper, because the obvious risks that are as a result of geopolitics, things like sanctions, for example, are very well known by the fintech community, especially if you're in the compliance side of it, especially anti-money laundering and sanctions and all of these different terrorist financing, all of these different phenomena that pop up is something which is very well understood. But what we try to do is to find the more non-obvious types of risks that fintechs will face and have faced and will continue to face in different ways as technology develops and as their offering as a fintech also grows and develops into different markets. So that's what we'll be doing. But to first understand this, I think a very clear understanding of what geopolitical risk actually is fundamental as a starting point. Because many may confuse political risk with geopolitical risk, and there's a big difference between the two. But we hear this used interchangeably within conversations, and it's not the best way, it's not the best approach to take. So the way we define it is that political risk are the risks that occur exclusively within the borders of a nation. And geopolitical risk is the result of nations interacting with each other in different ways, which cause risks for businesses to come up. And something even more fundamental than that, which proves this definition, is when you look at political risk insurance that are provided by the big insurance firms. They cover political risk, not geopolitical risk. And they cover many things which are within a nation's borders, like protests, like a change of regimes and what that would mean for businesses, issues in relation to allowing repatriation of profits, and many different aspects of political risk are covered. Geopolitical risk is a lot more difficult because it's hard to really, especially to someone who is looking at it in a very number-oriented way, and a probability and statistical models that are used by insurance companies, it's very difficult to actually to measure the impact of what a bilateral relationship would look like as an effect to a fintech, and even more complex than that, multilateral impacts on a nation by a number of nations on the fintech industry or what is connected to the fintech industry. So that's the main definition. Geopolitical risk, as you see here, is when two nations come together, or more than two nations come together in different ways, whether it be trade, whether it be kinetic warfare, whether it be issues in relation to trade disputes or currency manipulation or foreign direct investment, or any of these kinds of things which need more than one party involved to call it a geopolitical risk. Hence the word geo in there. So that's just the main thing to start off with as a fundamental starting point. So whenever you hear people speak about political risk, you need to ask them, is this a political risk which is exclusively as a result of what's happening in a nation's borders, or is it more geopolitical, which sees other outside players having an impact in that nation and in that marketplace? More likely than not, any kind of risk would be from a geopolitical angle. Very few risks are contained as a starting point, and also as an endpoint within a nation's borders, especially given population migrations where you have citizens of one nation or expats living in a different part of the world, then maybe putting pressure on their host country to help with the situation at home. That's what makes it geopolitical. But we'll go through the presentation further to clarify these things. As a starting point, when we look at now with your newfound definition of geopolitical risk, we need to go into a much deeper understanding of what makes a nation powerful. And our response to that is our centers of power concept, which we've developed. And in the most simplest way, we can say that the centers of power idea is what makes a nation powerful. As you can see in this graph, there are 6 axes of power that we believe not only makes nations powerful, but in the past, principalities of the past, empires of the past, and kingdoms of the past, and any other social grouping that were created before. And when you measure a nation on all these 6 axes, you have a much more sophisticated blueprint of what this nation's potential ambitions could be in the future, where they stand now, and where they may want to improve their offering in terms of their power to make them even more powerful. So let's go through them now. So the first one would be its active consumer market, meaning how much of the population has disposable income, which would make that market attractive for a business who is selling their products and services within that nation. That's what makes a nation powerful. What is the purchasing power of the populace of that nation? In the most simplistic sense, of a simplistic way that I can define active consumer market. Secondly, would be a nation's economic strength. So this typically would be measured by its growth and its GDP, but also it'd be measured on the power of its currency, the independence of its currency, and other aspects which makes the nation economically powerful. Thirdly, we measure a nation's systemically important and natural resources. So we look at things like commodities that it produces and natural resources that it produces, and how important they are to the international market, and what nations can then demand from the world because they have such sway over the commodities that they produce. So, for example, a nation like Saudi Arabia or Russia, within the confines of OPEC and OPEC Plus, has big sway over the oil price. As we saw during the Yom Kippur War in the early 1970s, they were able to block off access to their oil to the Western world, which really panicked a lot in America, which shows how a nation's systemically important natural resources can impact its power and its influence in the world. Fourthly, would be a nation's technological leadership, which is probably the most important part of this presentation, especially for fintech. So within a nation's borders, what is the innovation like within that country, and what types of technologies are coming out of it, and how they can be used by the companies which develop and utilize these technologies. So that's technological leadership, and one of the biggest players in this would be obviously America and China, but also others which are developing technologies like Israel, the UK, parts of Europe, and others as well. Fifth, we have its geostrategic positioning, and this is probably the most old school geopolitical understanding. Things like economic active consumer market and others may be newer to the full, but probably not. But geostrategic positioning is probably the most old school thing when you think about geopolitical risk. And this is defined as where a nation sits physically on the terrain, what is its topography like, how much access to the sea does it have, how many access to the sea and oceans does it have, is its neighborhood in terms of other nations around it, are they friendly to that nation or not? So more sort of more tangible physical aspects of a nation that a nation can't really change as much. For example, a nation's economic strength and active consumer market can be a lot more manipulable and developed as opposed to its geostrategic positioning. Typically, things like access to the sea, it's very hard to change. Very, very hard to change. You have very few examples of nations which have utilized this. For example, Egypt with the Suez Canal and the Panama Canal, which then made Egypt a primary force for international trade because they cut out the Suez Canal. But apart from once in a blue moon type events like this, then this is very difficult. Alliances may be a little bit easier to understand, especially when you look at terrorist financing. It's very important for fintechs to be looking at this. A nation's alliances and its foes, and what could be the repercussions of this for their terrorist financing checks and balances that each fintech has. And last but not least, its military balance. So this again is pretty straightforward, but how powerful is its military? How much can they project strength on the world? Not only more traditional types of projections like having a strong navy, having a strong air force, having a lot of numbers for your armed forces, but also newer innovations like cybersecurity, its leadership on that, which again is linked to technological leadership, and also its ability to project power into outer space. These are new kinds of military innovations which are important for fintechs. You may ask yourself why, but as a whole, these 6 axes really have a chance to really do a full MOT on a nation to check its strength and its power. And to give you some examples of how nations sit on these 6 axes, we have some examples of nations here. So the US, China, Russia, and Saudi Arabia are all mentioned from our analysis that we've done to really come up with defining their strengths as a nation, and also where they are strongest at, and also where they perhaps seek to improve their COPs so they become even more powerful. And I think some of the most dramatic thing that we can see on this map is the state of the United States. Typically, you can see the United States on all 6 axes. Its mark is over 80 for each of them, which shows its power on the world stage. But this has changed as the decades have passed, and each nation has a chance to change their power positioning as time passes. And there seems to be a theory that the reason why the US is less powerful these days is because somehow they're taking a back seat in world affairs, which means black holes are emerging in different parts of the world, which are allowing other nations to fill that void with their power. But in our point of view, this is a very simplistic and US-centric point of view on why the US is somehow losing power. A more robust, I think, answer to why the US seems to be not the major power in the world is not because they're taking a back seat, but other nations around the world are developing their COPs to the level where they can challenge the United States in their region. And specifically within parts of the COP, they're able to challenge the US directly for global dominance. And we see this, for example, with China having a score over 80, close to 80 in this case, where you can see Chinese technological leadership then now vying for dominance with the US. And other examples, as time passes, you'll see this developing too. And we have our own proprietary ways in which we measure this ourselves for fintechs, for them to understand how nations develop. And what's important to realize from this is that four major themes spruce up or come up as a result of developmental differential, as we like to call it, of different nations developing their COPs at different times. That's what's happening around the world now, where nations, because time has gone by, they've been able to develop and also not develop as fast as other nations in their COPs, which is why we see more geopolitical risk happening across the world. It's not because the US is becoming weaker, but more nations are becoming stronger. So the pie isn't getting bigger because the US is taking a smaller slice. It's the pie is getting bigger because more nations are now taking more slices, which is changing the game a lot. And what's coming out of this is what we call the G4 or the Global 4, which is emerging. These are characteristics in world affairs which are seeing a big time development as different nations develop their COPs, which include globalization is becoming more important. Geopolitical risk, as we mentioned, is becoming more important because nations are developing their COPs and they're having a bigger voice in the world, which is making their actions a lot more bold and quick because they can back it up now with different aspects of their sense of power to back up their words with actions. Also, technological transformation is also rising in different parts of the world, which is causing fintechs to then different companies to be developed with different offerings, different products and services for different markets in different parts of the world. And also societal change is also becoming a big aspect of the world now. And a great way to really encapsulate societal change is saying that more people are doing more things in more places. And you can apply the axiom to any situation around the world. And that the explanation could fit anything, which is important for fintechs to know because these COPs as a standalone are okay and will give you a lot of value, but knowing how to apply them in the real world by seeing how the G4, the global 4, as we mentioned, are impacting the fintech space. And in this segment, we're talking about how geopolitics as one of the G4 is impacting fintechs. And it's also important to realize in this slide that geopolitical risk is not a one-size-fits-all consideration. It really depends on what your offering is, what the geopolitical risk actually is and how that impacts your business, where you are in the market here. As you can see this graph courtesy of 11FS, which is a fintech. We saw this graph and we thought it would be a perfect explanation to explain the UK fintech space and how the different offerings, whether it be retail, wealth, SME, mid-market corporate, and the firms that have been created off the back of that, Robinhood obviously being an American firm, but we thought to put it in anyway, show how a company like Revolut has different exposure to geopolitical risk to, let's say, something like Robinhood. And understanding this is very important. And on the right-hand side of the screen, we have the supplier landscape, which is also courtesy of 11FS, which explain really the plumbing system for fintechs. So the service provider for fintechs, so they can live and they can grow. So we have KYC, sanction screening, payments, and also banking as a service. And the geopolitical risks there are different. They're not less by any stretch of the imagination, but they're just different in their application. And we'll talk about SWIFT as a case study in a few moments, and how geopolitical risk reared its head, and how SWIFT responded to that. And our final, our second to last slide here is a case study of Indian IT professionals post-Brexit. And we saw when Brexit, even now it's still a big point of contention for fintechs, and how they overcome the restrictions and the changes that Brexit has brought along. But the more obvious risk from Brexit was passporting rights for different companies, allowing their businesses to operate in EU markets, UK businesses who, because of the EU, were able to passport their licenses and were able to operate their businesses in the EU. That would be the more traditional form of risk that fintechs would be looking at as a result of Brexit. Something a little less obvious is this case study. As we know, when the UK left the EU, preferred treatment of EU workers was also abolished, which meant that the employment landscape was on a much more even playing field, where different employees from different parts of the world had equal access to employment opportunities in the UK. And from conversations I've had with those who know the matter a lot more, and those who are clients as well as our audience, we see potential influx of Indian IT professionals into the UK as a result of this loosening of or the abolition of this restriction. And with this, we will see a lot more potential Indian IT workers coming into the UK to fill up job spaces. And as a result of this, an opportunity will arise where we may see remittances from Indian IT workers who will be sending money back potentially to their families in India. So remittance service providers that are tailored to the Indian market may see a big boom in their business, a big growth in their business. So this will give a chance for competitors to also take a part of the market, also, but it will also allow those who want a piece of the action to see what could be the risks of remittances that are sent back to India. And a good way to measure this is by seeing, obviously, the situation with India and its neighbors, most importantly Pakistan and China, and to see what's happening there, and what could be the potential risks of sending remittances back to India without looking specifically at the FCA regulations, or not only looking at that, rather, but by looking beyond that. So this example of Indian IT professionals post-Brexit is a great case study to use to understand how this will develop into the future. And lastly, we have the case study of SWIFT and SWIFT's Catch 2022. And this comes off of the back of the JCPOA, the Joint Comprehensive Plan of Action that was signed pre-Trump with EU nations, with the UK obviously being part of the EU then, Security Council as well, with Iran on their nuclear weapons, or their nuclear capabilities. And when Trump shredded this agreement, he also put out an order for any company that wishes to continue to do business with the US would need to cut business ties with Iran. And many businesses, silently protested this because they saw this as a loss of revenue and a loss of potential income. And SWIFT was sort of caught in the middle as a fintech, because different Iranian banks, especially, were able to use SWIFT services to send payment orders through SWIFT to different actors and players in that Iranian banks were working with. Then the Trump administration put pressure on SWIFT to stop ties, and that also threatened, different measures like freezing assets of the SWIFT leadership team and others. So this is where you can see SWIFT being caught in the middle. And three major things came up as a result of this. Firstly, we noticed that compliance becomes more costly as different nations who were allies or are still allies but are developing different sanctions regimes, especially when it comes time to seeing things like Iran. We see the compliance cost increasing, because now with Brexit also happening, we see that companies who wish to do business in the EU, UK, and US now need to follow 3 different sanctions regimes, which is adding to the cost. Also, given the fact that the EU and US sanctions sometimes are diametrically opposed. For example, the EU has something called blocking regulations or restrictions which essentially make it illegal for secondary US sanctions to be followed. So any business which is an EU business which is following US sanctions could be potentially breaching EU sanctions, which is putting, these companies, fintechs and others, in a very difficult place. Secondly, this shows the risks associated with big players like SWIFT and sort of the too big to fail kind of mentality with them, because they are a hegemon in the payment space. They're a legacy firm also, which is a good thing, especially for firms who have worked with them. But then when risks like this come along, their response time to respond to these things were slow, and they were reactionary. And they made decisions on short-term thinking to get themselves out of that mess, as opposed to thinking long-term as to what could be the impact on their business, given they are such a key player in the fintech space, payment space, and they would be a natural target for different international actors in order for them to fulfill their own agendas. And thirdly, we see, and this is the part that I highlighted the most because I think it's probably the most important as a business opportunity. Seeing SWIFT moving so slowly in this and seeing their power, we see that this could be a big opportunity for challenger banks and challenger organizations, not only in terms of SWIFT's case, but other cases where they can say that, hey, look how slow these companies were to respond to these risks. Why don't you work with a company like us, who is a lot more nimble, a lot more forward-thinking, that we can respond to these risks, as opposed to working with these legacy firms which are slow to respond. So as a marketing and as a business angle, if these new challenger organizations can do a better job, this could be a great angle for them to promote how better they are than their competitors, if they truly are better. But that comes again to them understanding the geopolitical risks in a much more in-depth way. And that's where, and also the last thing I'll say is coupled with the UK legislation like PDS and PDS2, the Payment Services Directives, this allows challenger banks to now enter into the banking space, whereas before they weren't able to. So this opportunity opens doors anyway, but if they can use this geopolitical risk angle as a way to show the market that they are robust, they are forward-thinking, they're responsive, and they're preemptive in their analysis, then this will stand in good stead with clients and with customers into the future too. If you liked this part of the presentation, feel free to connect with me on LinkedIn. My name is Klisman Murati, as I mentioned, or again, just take your mobile phone, open up the camera app and scan the QR code to be connected directly to my LinkedIn profile, where we can have a chance to talk and connect there. Thank you very much and speak to you soon. Bye-bye.